Hey, good morning. This is Meir Valensky with Driving Markets. Okay, so last week the markets finished down on the week. A lot of fear factors, a lot of the inflation in interest rates, etc., the usual stuff that was frightening investors. On Friday, the non-farm payrolls came out better than expected, but the markets went down because that is going to add further fuel to the Fed to raising interest rates, because we've got a full employment, we've got full economy. As long as you have full employment, then consumers are going to continue buying, they're going to continue spending. If they continue spending, all that is going to do is fuel inflation. So with those strong numbers on Friday, 390,000 new jobs were created in the States. There looks like there's no end to jobs being created in the States, and therefore when you have full employment, you're likely to have rising inflation. So the markets came off. Everything came off on Friday. However, this morning the markets have all rallied on the back of China releasing more lockdowns or allowing more the economy to flow, and that has boosted Asian markets. As a result of that, boosted European markets, and the US futures are all up. But don't be taken in by it. Quite simply, that this fear factor of inflation and interest rates is there. In fact, the 10-year Treasury on Friday jumped to the highest since March of 2.94%, as investors looked at taking the money out of bonds and putting it into bank accounts and other interest-bearing securities, because as rates rise, that becomes more attractive, and the Nasdaq and high-tech stocks and shares become less attractive because you're getting a guaranteed return on your money when interest rates rise. So I want to be very, very clear where we're going. Interest rates are going to go this year to 4.5% in the US and in UK. I'm not sure about Europe. Europe may start increasing interest rates. They've made some indications of it. They've got inflation that's rampant, but they're going to be increasing interest rates, but probably not to 4.5% this year, even though they need to go to that level. In addition to that, you've also got this week the CPI in the States, the Consumer Price Index, and that is the inflation measure at consumer level in the US. You've also got the Michigan University Sentiment Confidence Report, and that comes out on Friday as well, and that will give you an idea as to how confident the consumer is. What is his feeling about inflation and mortgage rates and the overall economy? On top of that, you've got for the first time a loosening of the housing market. What does that mean? It means there's more sellers coming to the market than buyers. Now that could be an indication of sellers wanting to exploit the high values in their properties, or it could be an indication of higher interest rates. My opinion is that there'll be more and more sellers come to the market, and I expect the property market to drop in the next 12 months by 20%. That's 20, by 20%. The property market lags behind the stock market, so I expect the stock market to go down 40% and the property market to go down 20%. Bitcoin is up today $1,500 on the back of investors' appetite for risk, on the back of China opening up its economy, and that's got investors all excited and saying, let's buy the market. Don't be fooled. It's not going to go up any further. It's going to turn around and it's going to go down. That is my very extreme view, and that is my view. I'm a big seller of the market, so keep that in mind. The US dollar is down again. Investors, FX traders have sold the dollar because it is normally a risk haven or safe haven when there's times of uncertainty. But now, since the China's opened up and since the markets are higher this morning, the dollar's gone down. Traders have dumped the dollar and they've gone into other currencies which are high risk. For example, the pound is up against the US dollar, and the euro is also up against the US dollar. Elon Musk last week said that he has a very bad feeling about the economy. So he can't go from having a bad feeling about the economy and all the markets are up. He's going to shed over 10% of his his workforce. That's going to be 16,000 people are going to be made redundant. The high-tech companies, Google, Amazon, Facebook, Netflix, are all putting a freeze and laying off staff. That's going to be fed through to the market as well. So mark my words, we are going to go into a downward spiral, and any rise in the market is an opportunity to sell into it. The semiconductor chips, Nvidia and MU Microtechnology also fell down last week and dropped, as did Tesla, Facebook, Amazon, Microsoft and Google, on the back of those strong numbers from the US on the non-farm payrolls. Going forward, you're going to have a lot of volatility. Remember, I keep saying the trend is down, and overall we're going to go into a bear market, and we're probably going to see recession by the end of the year. So in my opinion, you should be selling Bitcoin, selling any high-risk assets, and look to get out of those high-growth stocks or the Nasdaq as soon as possible, because they are going to go down. This is Mayor Valensky with Driver Markets. Catch me on Instagram, YouTube, Twitter, and other media platforms. Subscribe, like. Remember, market's going down. Stay short, sell the market. Have a good day.